All right, yo. So what I'm gonna discuss or I'm gonna go over is compounding and risk to reward. You see me? So most people that already know what risk to reward is. Most people might not familiar. You know why you wouldn't familiar, but you see me. So risk to reward is basically what you risk versus what you expect to earn. For example, here so this red box here would be the risk. Green box TP. See? So you have different types of risk to reward. You have 1 to 2, 1 to 3, 1 to 4. Now the 1 to 2 you basically would be risking right here 24 points and you would be expected to earn. You are going to come out of the trade at 58, which is 2 times this. You have 1 to 3 where you just need for you would have close the trade at 3 times this. So firstly you would analyze like 24 points here. This is going to be my stop loss, and then you would evaluate and say, all right, cool. The trade possibly push higher, push up 3 times this. So this is where I would look for come out of the trade. Now, most people like myself, if I don't see me I get the risk to reward them I want, then I don't even bother insights. I don't really look for 1 to 2 or 1 to 1 or whatever. Because with a 1 to 1 ratio, you need a 100% win ratio. With a 1 to 2, you need a 50% win ratio. With a 1 to 3, you basically need a 40% win ratio. And with compounding, that win ratio can even be less and you still see profit. So most people always complain and say, them always a lose. You can lose 60% of your trade them and still make money. Simple. You can lose 80% and still make money. You can lose up to 90 and still make money. You see me? Once you have the volume on, yeah, you can make money. So 24 risk, 3 times reward would be basically yes, sir. So if me for risk with a 1 to 2, you see me? I mean the suburbs. Call it some use 0.80 times and then me lose first trade. Now I'm down $16. Now call it say me enter yes again, stop me out the same 24 points at 0.08. Now I'm lose 2 trade. That would now would have down negative 32 now. So 1 trade with a 1 to 2 risk to reward ratio would now probably bring me back to break even. And then the other trade would bring me in profit. Now, whole heap of people out there now win 50% of them trade. Whole heap of people. The probability of you winning 50% of your trade sometimes can be difficult, depending upon the type of trade they are, market conditions, whole heap of things. But you see me? Because it's now, I catch it, yes, sir. And now I win 1 trade. So that plus 0.80 times 40 bring me back a break even. Just use 40 for example, you see me? No, that would bring me in profit. So now you see say I want the tourist to reward ratio, you would need a 50% win ratio to see profit, for consistently see profit. For every 4 trade you enter, you need to win 2. Now, with a 1 to 3, then it can be lower. I really nothing, so I should have show this with. I'm gonna show it. Just for the visual aspect of it. You see me? 0.50 And call it say I lose 20 points. Now I lose 3 trade. You see me? 3 trade at 1 to 3. So yes, I lose. And then now I catch 1, which is like from yes to yes. 60 points. 1 to 3, me risking 20 points. Now I win. So 0 points. So now it's just a 1 trade I win, bring me back a break even. Now the second trade I win would now bring me in profit. So out of 5 trade, we lose 3, win 2, win a profit. With a 1 to 3, need a 40% win ratio. 1 to 4, then the percentage go down. So if you start at 50, and then with a 40 with 1 to 3, then the percentage go down. You see me? So that's basically it for us to watch. So what me try for the person is go with a 1 to 3 or 1 to more risk to reward. Something what I always do too is if me get up and me enter this, and like me see it up here, so now me see say me get my 1 to 3 already, and call it somebody win the previous one and me look a bit in a profit. Now me would have closed half of the position and then would have left it and see how far that can run to. Summertime this allow me to get hold it more. Hold it more. So once you reach close half, left it or woman do while me a compound, which me I get into, is the last entry, me left that and then make that run and then you know that because sometimes it run and then where you feel comfortable or where you might spot the next key zone, which would be more than likely up here, so then with a close out. Or if me see it approach a zone here, with a close out probably half of that position and then bring up a stop loss. About yeah, so. And then if anything go on in the breakthrough, then it breakthrough. You see me? So I think that's basically it for risk to reward. So the higher your risk to reward, the lower the percentage, your win ratio percentage needs to be a consistent profit. So most people say, oh, me lose this and me lose that. You lose 8 trade, you can win 1, go back a break even, and you can win the second one, and you're going a profit, and you say consistent profit. That's why you stay consistent. Now, with compounding now, me can lose 20 trade, or I can probably lose even 8, and then the 1 trade bring me back in profit. I'll say that again. So if I take 8 trade, I can win the last one, 8 out of 9 trade, 10% win ratio, you can get up and go in a profit. How you do that now is compounding. Most people should know what this is, and it's basically adding multiple entries to a trade. But you don't just fling in a bag of entries. So. Because you will fling in a bag of entries, trade, you decide, so, all right, make a box there that the Christian man and just turn back. Is me. You don't really want that. So compounding is really have to look at market structure and then add multiple entries. But over here, so again. So me lose 80 points. 80 points times my lot size, 0 points. I don't know why I'm gonna do this. That's right. So call it you are use a small account and you risk like whatever this is per trade. $2, $3 per trade and you lose it. $2 per trade, you lose 8 trade. How you win back 1 trade and make back one? Now call it say me a trade with a 1 to 8. And me catch the trade. My first entry would have been here when it pulled back. Now, I risk $2 per trade, as I say. And then now I'm really look for 80 points. So 80 points would be about, yes, sir. So first entry here, sir. Second entry would have most likely be here. Third entry, more likely here. Now this is a 1 trade attack. We're gonna do the maths now. Now see. 80. So far, you can see say the first entry, 1 trade alone bring me back to break even. That alone give me 80 points. You know, I remember me this. Plus that bring me back. Yes, sir. So how would I get a 10% win ratio now? Win 1 trade out of 9 and be in profit. Compound. At the second entry here, sir. And then that will now be basically 60 points. So now second entry for that trade, bring it back in profit. Third entry, basically whatever points, you get a message. 8 trade attack, basically, I will win 1 and then that bring in profit. Now you might think say basically this are adding, this are just like a next trade, which is basically it. But what we do compounding is the reason why people probably call it scaling and not a next trade in its entirety is there's a certain element to do it, you see me? Hold on. Alright, so what am I say? Oh, scaling. The reason why people consider scaling and not necessarily a next entry would it more than likely just look like me enter some other trades is when me enter my first entry here and my second entry here, then me wouldn't have the same stop loss where they below yes sir. Because if you compound like that and you enter yes and the trade turn back, then that are basically 2 to 3 times the loss. What me would I do is my lot size would I now determined by how much profit me in a yes sir. So I see it push, pull back, and I see it and I say alright. And now when I make this entry, my stop loss would be here. And my stop loss would basically be a little bit below the zone and the entry price would basically be risking some out of this. So even if we get up on any trade, get up on me enter and it go up and it turn back, then this will basically stop me out. Probably stop me out in a negative, but it would be negative of some of the profit on me in a yes. In a compound, you don't have like 1, 2, 3, 4 into the same stop loss. You need you're basically risking the profit from the previous trades that you enter. You see me? So probably that's why you know, I'm call it scaling and not necessarily adding entering more than 1 trades. You see me? So you do it. You can lose 8, win 1, you make back. Everything we lose, no profit. This reached me several times. And I always I win, but we reach a point where I lose so much some of the time I win by accident, for sure. Yeah. You see me? Now, compounding different time frames. What you're gonna really need to look on is one, the whole structure of the trend, and then you need to alternate between the different time frames. Now, if me catch a hourly trend, I'm more compound like just a few entries, then I wouldn't go to the smaller time frames. You see me? I wouldn't go to the smaller time frames. But I just work with the hourly. First entry also. Once it break above here, pull back. Second entry. And then once it break above this, a pull back. Third entry. But call it to me, you want to get up on. You see me? Run up the trade. Then what would I look on is basically the structure here. And then you're going to need to be mindful of the impulsive move along by the what we call the counter trend, the correction. Now, how me would I compound this on a smaller time frame? Call it to me enter the trade. Yes, sir. And me see it and make an impulsive move. Once me have certain confirmation, say it I form an impulsive move and a pullback, me would have then identify this impulsive move, go to the smaller time frame, and then compound from the smaller time frame. I don't know why to do this. Come on, there, the better. But alright, cool. How am I gonna compound this now? How am I gonna compound this? And then what most people afraid of happening is this happen to them. Them add 1, 2, 3, 4 inch and then it pull back. You have to really understand the counter trend and the impulsive move if you really know. Alright. What me do? First thing, a double base. You see me? Entry here, so you see price break above the high. You see that this is a level of resistance. You see me? I want to say break above the high. We get the breakthrough candle, the close above, pullback, rejection, and then we get the decision candle. Entry would be here, stop loss below here. Second entry here. Now we see we push above, the same thing, breakthrough candle, we get the candle close above, we get the pushback rejection. Third entry, would possibly here, stop loss below this. Push down, pullback. You see the wick rejection followed by this one. Next entry, what I go here, so believe it or not. And then ropes. And then what me would do at this point is where me I would watch it on a smaller time frame. And then what me I gonna do is analyze and say, alright, cool. More than likely on the hour time frame, this I gonna show you one impulse to an area, and then you know, so alright, probably pull back. So what me would do at this point is try to identify like an area in which we expect it for pullback. And I say, alright, cool. The double base here, so more than likely in I go pull back to this point. So my first 2 entry them would have probably safe. But this them 3 entry, me would have close them out. And then me would have await counter trend for farm. And then once we get the counter trend for farm, I'm say pull back to a structure level. I'm see it start push again. Now I'm gonna enter again. But now because me have the profit from this, the lot size is probably bigger. You see me? So now I see where it push down, I'm see it reject a area. I say alright, cool. I see it push up, pull down. Cause it's I'm not trust it as I see it push down. I say alright, see it there now, see the trend there. See how the look at trend line so farm, 3 touch. Me I go over entry so. On the entry there, I go basically be risking. Look a bit at the profit I want to close out already. And then you want to see some structure, you want to see push above, break above, and then you really add entries based on the structure where it's a form. And if you see where the impulsive move, or you see price I do an impulsive move and it approach like certain rejection areas, then at these points I will move a close out. So like me see it push so, push down, more than likely entry with the other some see it push up, feel for break, then more than likely I'm gonna just close out some. You see it push down, and this is one area me always showing. The area where structure change. I always surprise test that area over the course of the trend. And I see it push down to Yasa. Yasa now, I will go in again. And because I see this clear, I see it reject Yasa. Yasa is when we probably go with the momentum and me had like on 3 entry Yasa. And I see it push up double base, then we probably close out some. All of this while them two entry are running as same way. And then we see push up, push down. See the same area they mark again, the area where structure change. Yeah, so is when we go and do some aggressive thing like 1, 2, 3. But remember, I'm not really risk not much because I'm basically a risk from some of the profits I'm close off here, here, and them areas. Yeah, so you see me? And then now we see push up, go on, do your thing. And as me add interest, so me I close out. And then you see where a structure form again. Yes, sir. Multiple entries here. Push up, push down, feel for break. Big rejection. More than likely you're gonna see this on the hourly time frame as a area of resistance. And you see it. Take time and feel for break, you don't know say. Then you close out. Or over the course of the trading, what gonna happen to is that you're gonna see where prices are take form and thing, and you're gonna realize what it do and where it now pull back to so. Like them NGO I'm gonna take here so and them smaller ones here so, then them here would have more than likely probably still remain. Them here when me the lowest point them I want me close but the one when me catch like up top closer to like strength resistance areas during the impulsive move then them here close out to increase to that size. Basically. And then all the time price are gonna move like this with a whole heap of pullbacks. So my time it'll just start like this and just push. You see me? Now if your surprise do like that and you compound then basically same principles you follow. Because at some point it's going to complete a counter trend. It have to do something on a smaller time frame and then you push out. So you do that same principle, yeah, which is wait upon the counter trend for farm, wait upon structure for farm again, enter. When you see it reach like on resistance, you close out some. Nothing real complex. You just have to practice it and then train your mind. You notice this look like something new I look on and even you see me? You just have to practice and train your mind to like certain things, you see me? So them look at thing the way you see me show now, more than likely when you enter like when you look at 5 minutes down here, so yes sir. You see me? You're gonna see price that take shape like this one hourly. And then you're gonna see it a form clearly some things clearly on the hourly where you're gonna have some entries like yes, and then you're gonna say, oh, this in line with structure, this in line with the trend line. So we can just left them there. You see me? So basically that. What up? Hey, lucky, you know? Sure, God. Yes, so my time, most of the S them, some of the S them are gonna move like this where you see it barely pull back, but then you see where it eventually do pull back. You see me? And when you catch a counter trend, you see the counter trend happen 1, 2, 3, 4, 5 wave, and then you enter the local entry them here, so and you zoom out, you're gonna see so but this is a key structure level, and you might see a big push from here. Probably would I do some more aggressive trading here when we see it a bounce from half of the key zone, then you see me. Like yes so now, break below, pull back, boom, see it push, just push right down. You're gonna see mostly a downtrend for the 5 minutes, but you're gonna see few little area where you can spot a counter trend and then just work your entry based on them days, see me? Nothing really complex. So by the time you compound and then it gonna stop you out, it gonna this, it gonna that. But the key thing is if you compound right, when it stop you out, it should stop you out. In profit, it shouldn't. you shouldn't be losing. If you have 3 entries in a trade and price pull back and stop you out, then you should be in profit. You shouldn't have a 3 stop loss, the one in the 3 trading with the 1 stop loss, the way against on price pull back and then intercourse the account. Is it so? Basically that. I don't remember what else we did for discuss, but when I remember then we do it. We do the next video upon it. Is it? So, that is it.